Hello, good morning, guys. Eh, This is Max G FX channel. So, welcome to my channel. And now we'll be continuing our lecture slides. I told you that I have some 10 solid lecture slides for you guys, 10 solid one. So, please be following the lessons so that you can get most out of it. All right. So, in this lesson, what are we going to talk about? But first, in our previous lesson, that was lesson 3, we studied some basic terminologies and also what moves the markets, choosing a forex broker, and also forex trading platforms. So this is what we discussed on our previous lecture. So please, if you don't know anything about it, then please I'll encourage you that you go back, go and watch it, and now please understand it so that your progress will be consistent and your knowledge will be upbuilding. All right, so in this lesson 4, what I'm going to talk about, we are going to talk about some key contents. That's history of forex trading, the types of charts, candlestick charts, time frame, and also some basic terminologies. Okay, so so the history of forex trading. So the concept of currency exchange dates back to ancient times. So in 1971, the Bretton Woods system ended, giving rise to the floating exchange rate system. So forex became accessible to retail traders in the 1990s with the rise of the internet. So today is the largest financial market with over 7 trillion in daily income. So basically, this talks about the key understanding in our current. So that's the rise of the internet. Now it has become a digital based trading system. So first it was manual, the Bretton Woods. So it was manual trading, which means that if you wanted to buy, you have to go to the stock exchange in order to say, please, I want to buy this. So you buy there. You can't do it on your at home. You have to go to where the stock exchange market is located in order to buy or sell. So yeah, so those ideology in those dates are still needed in today's internet environment too. So the same ideology are still needed now. Yes, so please, that's the main thing I want you to get. So yeah, so let's look at something like this. So in the previous years, what were they using to predict the market? They were using the internet. They had to rise the price they want to buy, give it to uh, the one responsible for placing trade or the broker. So they are directly to the broker. So they just tell him the broker will buy or sell. So if they want to buy at a certain price, how would they know the price they want to buy? Like, at what point would they know they want to enter the market? And remember, those days they don't need to draw a line across the charts like the way we do as support and resistance. So how did they do it? So they use the daily candle. So the daily candle was very important in those days. And the same today. So the daily candle also is very important now too. So please don't forget. So this makes it clear that the daily is the most important time frame in the market. So it's not so those days they weren't using like the 1 hour, the 4 hour, what was the market is doing in this period of time or that. No, they were looking at the day, what was happening in the day. Yes. All right. So yeah, so now it has over 7 trillion daily volume. So a lot of markets. How much or yeah, how much will you take home? How much will you get from the market? So that's the question of the day. All right, so the types of charts. So there are many types of charts now. So there are many of them, but I want us to focus on just three charts. So the three of them that we are familiar with. So that's the line charts. So the line chart connects closing prices over time. Simple and easy to understand. It's very easy to understand. Connects closing prices over time. So you can clearly see the the trend of closing prices over a certain period of time. And a bar chart shows opening, high, low, and closing prices. So exactly as how we know the bar charts, it looks like just a candle, but just that it just shows the opening, high, low, and the closing prices. That's also fine. And also the candlestick chart. So this is the most popular, provides clear visual aid of price movements and patterns. So the candlestick tells us more than the comparing to the line and bar charts. So yes, so the bar chart shows the opening, high, low, and closing prices. The candlestick also does that, but the candlestick does it more because the candlestick also uses the body of the candle to also tell us more information about what's happening in the market. Yes, so it provides a clear visual price movements and patterns. And using of candlestick, what is the most popular? It means what you see, others also see. And also because the candlestick is the most popular, it means it is very relevant in trading. Very, very relevant. So I'll just encourage you to stick to the candlestick patterns. If you would want to change to other types of charts like the line or bar charts, then you can also do so if only it is okay for you. All right. So the candlestick chart. So each candle represents price movements within a chosen time frame. So if you are in a 5 minutes time frame, it means each candle is made up of a 5 minutes time period. So each candle is made up of a 5 minutes time period. If you are in a 5 minutes time frame, so let's say I choose a time frame to be of the daily, then it means each candle is a daily candle time period. That's what it means. Each candle is a daily time period. Okay. So the body is just the difference between the opening and the close price. And the wicks, so the wicks is the high and lows within that period. And a bullish candle, so bullish candle just means that the price closed higher than it opened. So it's bullish. So it means it was optimistic. So we anticipated to go up and it went up and it closed up. Yes. All right. So the default color for bullish candle is green. So when you open a trading view, the default color is green. So you can clearly see this is the bullish candle. So the green one is the bullish candle, the red one is the bearish candle. So the bearish candle price close lower than it's opened, and the default color is red. So yes, so if you want to really take notes, you can just pause the video and then take notes of where the high is, the low is, how the body is, the opening price, the close price, and all that. Okay. So now the time frames refer to the period each candlestick represents. Example, the candlestick can be of the 1 minute, 15, 1 hour, 4 hour, daily, weekly. It can be of the 3 minute, 10 minutes. It can be of any type. We also have 45 minutes time frame. Then we have yearly time frames. So the lower time frames. So the lower time frames are the lower time frame can be categorized as the time frames below the 1 hour. So any time frame below the 1 hour is categorized as a lower time frame. So there's more signal and also there's more noise. Yes. And the higher time frames, it has clearer trends and also stronger signals. So yes, let me confirm something right here. So now, if you are trading with lower time frame. For me, lower time frame means anything below the daily candle, the daily time frame. So anything below the daily time frame is known as the current price. So that's the current price. So it means it is happening within the day. So the 4 hour is happening within the day, 1 hour within the day, all of it is within the day. But when you take the daily to the weekly, that is called the past price. So those are the really the higher time frames. And always what I tell my students is that if you want to find a place to buy and a place to sell, that's identifying a clear area of interest. That's finding lower prices and higher prices. It means you have to do it on the higher time frame. That's the daily, weekly, monthly there. But if you want to enter the market, that's when you need to analyze what is the market really happening now. So actually you could have buy us anywhere, but because of our capital, we don't want to lose in the market. So we need to enter with some small analysis on the current price before we enter the market. Okay, so now let's look at another basic terminology. So we have the ask price. So the ask price simply means the price to buy a current pair. You also have a bid price, so the price to sell a current pair. So the ask price is normally above so the ask price is normally below the current price, normally below, and the bid price is normally above the current price. And the current price is the market price right now. So the price right now, yes, is normally in between the ask and the bid, yes. And now the stop loss. So the stop loss is the automatic close to a losing trade. And now the take profit is the automatic close to a winning trade. So if you are winning a trade, you can say, okay, when I earn $500, I want to get out of the market. When I lose $100, I want to get out of the market. That's the stop loss. But the money you're expected to get is your take profit, and the money you're expected to lose is your stop loss. It's automatic. You just set it, and now it works for you. Just lose the trade, and you can sleep. When it hits your takes profit, then yes, you have made money from the forex market. Congrats. So yes. So yes, this is how we end our lecture 4. It was very brief and simple because I've been hearing a lot of comments that they want to that my videos are a bit lengthy, so I want to make it very short so that it's easy for us to watch and understand. Yes. All right. So this is the end of this lecture 4, and see you in lecture 5. Yes. So thank you very much for sticking around. This is Max J FX. All right. Bye.